Imagine a world where every dollar you earn, every loan you take, every pension you depend on, is part of a giant, invisible chain. A chain stretching across centuries, continents, and empires. A chain that binds governments, corporations, and ordinary citizens alike. This is the world of debt. Not the casual, personal debt we think about: mortgages, credit cards, student loans, but the global, systemic debt that moves like a shadow over the entire economy. Trillions of dollars, promises made long ago, interest compounding silently, invisibly, relentlessly. And yet very few understand who truly benefits, who is trapped, and how this system was built. Welcome to the hidden world, behind the global debt crisis. Here, money isn't just currency, it is control, influence, the power to shape nations, markets, and even human behavior itself. By the end of this journey, you'll see that the global economy, the one we believe is free and rational, is, in reality, a carefully orchestrated web of obligations, contracts, and invisible leverage. And within that web, a few understand where it begins and who really holds the threads. It began long before our generation. Centuries ago, rulers discovered a simple truth: it's easier to borrow than to conquer. Wars could be funded without raising taxes. Infrastructure could be built without immediate revenue. Entire economies could expand by promising tomorrow's earnings. But every promise had a cost. Debt isn't neutral. It binds. It obligates. It gives leverage to those who lend while obligating those who borrow. The earliest forms of government bonds, loans between kingdoms, and merchant credit lines laid the foundation for a system that now spans the globe. By the 20th century, this system had become dizzyingly complex. Governments borrowed from banks. Banks borrowed from one another. Countries borrowed from international institutions. Debt began to spiral, compounding silently, invisibly. And the rules were always the same. Interest must be paid. If not, the consequences ripple outward, sometimes subtly, sometimes catastrophically. Consider the 2008 financial crisis. Most people remember crashing stock markets and failing banks, but beneath the headlines was a quiet truth. The global debt machine had reached a critical threshold. Mortgages packaged into derivatives, governments issuing bonds to cover deficits, banks leveraging beyond their real capital. Each failure was part of a chain reaction, a system so interconnected that no single entity could escape its consequences. The crisis revealed a truth few wanted to acknowledge. The global economy was running on trust and very little else. Who controls that trust? The answer lies not in politicians, not in citizens, but in a network of financial institutions, central banks, and shadow entities operating across borders. Institutions like the International Monetary Fund, the World Bank, and countless private investment funds act as both lenders and arbiters, shaping policy while quietly enforcing repayment. And their tools aren't coercion or armies. Their tools are contracts, interest rates, and the ever-present threat of insolvency. Every fiscal decision we take, raising taxes, cutting spending, bailing out banks, is a move on this enormous chessboard of global debt. But most moves are invisible to the public eye. The crisis is ongoing, not because of mismanagement alone, but because the system itself is designed to expand indefinitely. Debt grows faster than economies. Loans multiply faster than production. Governments, corporations, and individuals are all caught in the same accelerating cycle. Yet the machinery that created this system is rarely examined. Its architects remain largely faceless, its principles hidden behind spreadsheets, legislation, and financial jargon. But the consequences are visible everywhere. Rising inflation, shrinking wages, social unrest, and a constant tension between short-term survival and long-term collapse. And now, more than ever, the world teeters on the edge of another tipping point. Because debt isn't just numbers in a ledger, It's leverage over life itself, over nations, communities, and futures. So how did we get here? And why do crises repeat, with greater force each time? To understand, we must trace the origins of modern finance, from sovereign debt to global banking networks, from currency manipulation to the creation of money itself as a form of power. It is a story of ambition, innovation, greed, and quiet control, a story that is as unsettling as it is illuminating. The camera would slowly pan across a dimly lit vault, gold bars stacked behind bars, clocks ticking. Because the world's economy is not just failing sometimes. It is designed to fail in small cycles, over and over, for those who know the rules. And those rules have been written long before most of us were born. The story of global debt is a story of evolution, one that began centuries ago with kings and merchants, and continues today in the halls of central banks and boardrooms of international finance. In the 17th century, the first modern government bonds emerged. Governments needed money for wars, infrastructure, and expansion. They borrowed from wealthy individuals and early banking institutions, promising repayment with interest. It was a simple concept, but its consequences were profound. Debt became a tool of control. Nations could wage wars without taxing their populations up front. Armies marched funded by promises of the future. And those who lent the money gained leverage not just over kings, but over entire nations. By the 20th century, this leverage had grown into a global web. Central banks, both public and quasi-private, became the architects of national economies. They could adjust interest rates, influence inflation, and effectively dictate the terms of borrowing. Debt was no longer just a ledger entry, it became a mechanism of influence. Take the International Monetary Fund, IMF, and the World Bank. Established after World War II, they were designed to stabilize economies and rebuild nations. Yet their loans came with conditions, structural adjustments, austerity measures, and policies dictated not by local needs, but by global financial imperatives. Countries became tied to debt in ways that limited their autonomy. Their citizens felt the consequences in rising prices, reduced social programs, and economic stagnation. Debt is deceptively simple, but its mechanics are far-reaching. Interest compounds quietly, invisibly. One unpaid loan can cascade into defaults, currency devaluations, and global market panic. Entire economies can teeter on the brink, not because of incompetence alone, but because debt is inherently self-amplifying. Then came the 2008 financial crisis, a stark reminder of this reality. Banks lent money they didn't fully possess. Governments guaranteed loans they couldn't entirely back. Mortgages were bundled into complex derivatives and sold worldwide. When defaults rose, the domino effect spread across continents. Markets crashed, economies froze. Governments intervened, printing more money, issuing more debt, and passing the burden to the public. The crisis wasn't a glitch. It was a feature of a system designed to grow and grow beyond its means. Debt is power, but the most dangerous kind is invisible. Modern money itself is largely created by private banks, not governments. When a bank issues a loan, it simultaneously creates a deposit, new money in circulation, but also a new obligation. Every loan expands the economy, but also expands indebtedness. The system thrives on growth. Without continual borrowing, the entire machinery risks slowing down or collapsing. This is why economic collapses are not random events. They are inevitable consequences of the structure itself. And yet most people assume money is neutral, that governments spend or earn like households, that banks simply store existing money. They don't. Debt-driven money systems are engineered to compel growth, ensure dependence, and concentrate influence in the hands of those who understand the invisible rules. The hidden world behind the global debt crisis is a world where trust is currency, where credit is leverage, and where default is the ultimate failure, but also a source of opportunity for those who hold the strings. The truth, when revealed, is unsettling. Debt is not just a tool, it is a mechanism of control. Every interest payment reinforces the hierarchy of global finance. Every bailout shifts the balance of power. Every new loan strengthens the invisible chains binding nations, corporations, and individuals alike. The architects of this system are faceless institutions, but their methods are clear. Create dependence, normalize borrowing, and perpetuate cycles that few fully understand. And because the system is so intertwined, no single government, bank, or individual can break free without enormous disruption. The global economy is, in a sense, a house of mirrors, every reflection dependent on another. One crack can cascade, and cracks appear more frequently as debt compounds faster than production, faster than wages, faster than the population itself. Yet those who study the system closely, economists, financiers, historians, recognize a paradox. The very mechanism that enslaves is also what sustains civilization. Wars are financed, infrastructure is built, industries grow, and societies flourish, all on borrowed promises. Without debt, the modern world as we know it would halt. It is a subtle, dangerous truth. We live in a civilization built on leverage, sustained by trust, and vulnerable to collapse. And we rarely stop to realize how fragile the entire edifice truly is. Today, global debt surpasses $300 trillion. Every nation, every corporation, every citizen participates in this vast web. The system promises growth, stability, and prosperity, but hidden beneath the numbers is a quiet, persistent tension, a system that grows more dependent, more leveraged, and more fragile with every passing year. We like to believe we are free actors in the economy, making choices, earning wages, investing wisely. But the rules of the game are set elsewhere, in institutions and contracts that few fully see and even fewer understand. The global debt crisis isn't coming, it has already arrived, slowly, invisibly, and cumulatively. Inflation, bailouts, financial speculation, austerity, these are its symptoms. The hidden mechanisms remain as powerful and as quiet as ever. And perhaps the most haunting realization is this: debt is not just numbers in a ledger, it is leverage over nations, control over individuals, a force shaping our collective future in ways we barely perceive. We live in a world built on promises we cannot fully repay, sustained by trust we barely question, and controlled by systems designed to ensure dependence. The chains are invisible, the consequences are real. And the deeper truth lingers. The global economy is less a free market than a carefully orchestrated web, one in which collapse is inevitable, but also, paradoxically, essential for the system to survive.